Okay, so good afternoon again, and welcome to everyone who has joined us so far to the Money Matters webinar, 25 Financial Planning Strategies for Older Adults. We will start the program in just a few moments, but first I have a few requests and some information. Links to the NYPL privacy policy and the Zoom privacy policy are now available in the chat box. This program is being recorded. A link to the recording and a PDF of the speaker's PowerPoint will be sent to all registered participants within the next 24 hours. Please put all questions in the Q&A. That's a change from what we used to tell you to do, so I know that's a little difficult, but if you will put your questions in the Q&A, they will be answered throughout the program. So, without further delay, it is my pleasure to introduce Dr. Barbara O'Neill. She is the CEO of Money Talk Financial Planning Seminars and Publications, where she writes, speaks, and reviews content about personal finance. Dr. O'Neill is a distinguished professor emeritus at Rutgers University. She has written over 160 articles for academic publications, received over 35 national awards, is a past president of the Association for Financial Counseling and Planning Education, and a next-gen personal finance fellow. Dr. O'Neill tweets personal finance information using the handle @MoneyTalk1 and writes weekly posts for her Money Talk blog. Now, Barbara, would you please begin your presentation, and welcome.
Welcome. Well, thank you, Kathleen. I'm very glad to be here and speak a little bit about some of the transitions that people make in later life and the financial decisions that they need to make. So as you heard, I am a full-time financial education entrepreneur. I just want to assure you that I am not going to be selling you any products or services today for two reasons. First of all, it would be against the library's policy for sure. And number two, it's not what I do. My clients tend to be companies, nonprofits, or companies that hire me to write, speak, or review content. So just so you know that. And just a little bit of street cred. I am 65 plus myself. So it's not going to be a presentation by a 20 or 30-year-old who's telling 60, 70, or 80-year-olds what to do with their money, because that sometimes could be a little awkward. I am a resident now of Florida. There's some pictures there of my house and my home office for Money Talk. And I lived in New Jersey for 41 years when I worked at Rutgers University. So I'm very familiar with the New York metro area as well. So I'd like to start out with a question, and this you can put in the chat because it's a question we're going to discuss together. And that is, what do you see as some of the biggest challenges that people are facing in later life? Either you've seen it yourself, you've seen it with your parents, you've read about some of these issues. What are you seeing as some of the biggest challenges that people will be facing in, let's say, the last third of your life, maybe your 60s, 70s, 80s. So we've got making your money last and having a place where you're not a crime target. That's interesting. Making your money last for your lifetime, loneliness, money. Interesting. So we're getting a mix of financial issues, social and emotional issues. Anna's saying the IRMA tax on Medicare, relationships with a variety of age groups, uncertainty about what you need, how much money, passing along property, tax issues, medical costs. Okay, so you're hitting a lot of issues, and about 75 questions were submitted in advance that I received yesterday, and many of them also touched upon the issues that you're mentioning in the chat. Beverly has a good point too about ageism, making it difficult to get a job in later life. Okay, so let's recap some of the challenges that older adults face. A big one is, when do you claim Social Security? And we'll talk about that later. And then once you get Social Security, it may be taxable. So that's another issue. And then we got required minimum distributions that kick in at age 72. And then making sure that you have enough tax going to the IRS, because you're generally going to have multiple sources of income. You might have a pension, Social Security, the RMDs, investment income. So in many cases, it makes it more difficult to estimate taxes when you've got money coming from several different sources. And then there's issues related to health, insurance and Medicare, possibly a supplement to Medicare. Long-term care planning is another issue, housing decisions, and some of the others here too. Again, we have an agreement on the ageism and taxable accounts versus qualified accounts. Okay, so there's just a whole lot of challenges and decisions. And I would say that probably having lived a young adult life and a middle adult life, and now kind of in the latter third of my financial life, that people probably have more financial challenges and decisions in later life than at any other time. There's just so many more issues to deal with. Another thing that affects people in later life is that we have kind of changes in our mindsets and our aspirations. You know, when you've reached a certain age, and maybe it's the big 50, 60, 70, whatever it is, you start to think about, what have you done in the past? And what do you still want to do? You know, that proverbial bucket list. And of course, many of us have experienced, basically a 2-year setback on our bucket list of things that we wanted to do. So there's lots of pent up demand to do things that were postponed during the pandemic. People often have an increased interest in giving back, living a legacy, philanthropy. They become important topics in later life. Simplification becomes important too. People want to downsize and simplify, and that can be simplifying your wardrobe, simplifying your personal finances. And another thing that I write about in my book, and I'll talk a little bit about my book, Flipping a Switch, later, but I'll mention this now, is that one thing that I don't think I ever fully appreciated when I was a young adult or even middle-aged was the change in your time set, and how you think about things when you've lived more years than you have years left to live. So I have a chapter in my book that talks about lasts, like thinking about, will this be my last car? Will this be my last cruise? Um, and then I kind of coined a term, roll calculations, return on life expectancy, where people start thinking about, okay, if I buy this, how many more years do I have left to use this? And that chapter in my book is actually called Green Bananas, Lasts, and Roll Calculations. And it came about because when I was in my 40s, my mother, who was in her 70s, used to talk about, well, at our age, we don't buy green bananas anymore. And I never quite understood that. And I would say to my mother, what do you mean, Ma? You're not going to live long enough for the banana to turn yellow? And I just didn't get it. But I get it now as an older adult, that we start thinking about, how many years do we have left? And even in particular, how many good years do we have left? And I've heard a number of my neighbors here in my 55 plus community here in Florida talk about the fact that they didn't just lose 2 years of opportunity due to COVID, but 2 good years, because their health is good now, but they don't know what it's going to be like later. On the list of questions that came in, somebody did ask about what are some of the common errors that people make. So here are just a few. Some people just think that they have to make a very drastic change in their investment strategy just because they hit a certain milestone age, like 65, for example, or if a certain life event happens, such as widowhood. And generally speaking, drastic changes, drastic, very sudden changes are never a good thing. Any strategy that you're thinking about, you need to think it through and plan it through, get information, and then make your decision. People sometimes forget about the effects of inflation. We're starting to hear more about inflation this year because we have the supply chain issues and supply and demand pressure because of all these bucket lists that have been pent up for 2 years. But previously to the pandemic, we weren't thinking very much about inflation because it was very low. But keep in mind that using the rule of 72, if you divide even say 3% inflation into 72, prices will double in 24 years. So you start out your retirement, let's say at 62, by 86, everything that you would have paid for in your 60s is costing twice as much roughly in your 80s. So that's something to think about. Another error that people sometimes make is just relying too heavily on financial salespeople. So it's always a good idea to just get several opinions, do some research yourself, and really carefully consider any decisions that you're making. And then a final error is just assuming that estate planning is for rich people, whoever they might be, whatever number you want to use, a million or whatever, where in reality, anyone who owns any kind of property should be doing some estate planning to make sure that their assets go to the people that they want them to go to, and also that provisions are made for incapacity, for example. Who's going to manage your affairs if you're unable to manage them yourselves? So those are some common errors that we sometimes think about. Some others are retiring without planning out what you're going to do for healthcare coverage. And that becomes particularly important if there's a gap between when you leave the workforce and 65 when you can get Medicare. So again, this requires some planning, looking at options, possibly the healthcare marketplace, or other sources of healthcare insurance so that you're not without coverage at any point. Not developing a long-term care plan. Notice I didn't say necessarily insurance. Insurance could be part of that plan, but just thinking about what would be your plan if you needed, let's say, care in a nursing home or assisted living expenses, something of that sort. And then we're going to talk more about this in detail, improper asset withdrawals. Some people take out not enough money, and they're running into some issues with RMDs or something like that. Sometimes people, and this is really the focus of the first chapter of my book, is people kind of unnecessarily restrict themselves and could actually be taking out more money than they are. So just looking at how much you're taking out of your various accounts, and we'll talk more about that. And then another big error is not communicating about your finances with your loved ones, with the executor of your estate, whoever you've named in documents to carry on your finances. Just not talking to them about issues, that can be a major error. And also making sure that they know where your key documents are. And I'm going to talk about some lists that you might want to prepare to kind of summarize your financial information. And you're going to want to share those with your trusted loved ones as well. Okay, so those are some of the issues that people are dealing with and some of the errors that people make. So at this point, I think I'll stop and see from Kathleen. She's asked you to put any questions or comments in the question box. So I'll just check with Kathleen and see if any questions have come in. Meanwhile, I'm seeing a comment from Roseanne about the low interest rate environment. And yeah, that is a big issue, the rates are much lower. They may start to notch up a little bit toward the end of the year. There are some bargain places, though. A lot of people aren't aware about that right now. You can get 3.54% on an I bond. So that's one place that you could put money without any risk and get a better rate, about 170 times what the average rate on a bank account is right now. The only limit there, of course, is it's only $10,000 a year is the limit that you can put into an I bond. But good point about the low interest rates. So Kathleen, any questions that have come in?
Yeah, it's kind of a general question, and you may be getting to it later, but how do you replenish your 401k after taking a bunch extra out during the past COVID months? And also sort of readjusting your retirement plan when perhaps some family members died due to COVID.
Right. Well, COVID has been a major hit on the finances of a lot of people. And, some people have actually done well as a result of COVID. In fact, there was an article in the Wall Street Journal yesterday that talked about the increase in wealth in the United States as a result of COVID. But unfortunately, there's been others who have been hit hard. And as far as rebuilding the 401k, you just do it the best you can. And the same would go for emergency funds too, because many of them have been hit as well. Just save as much as you can, and which is probably going to involve cutting back on expenses as you're able to do that, trying to just rebuild it any way that you can, authorizing higher payroll deductions. Probably the best time to authorize a higher deduction would be if your salary increases or if you change jobs to get a better salary. And many people are doing that right now. We're in a time where a lot of people are switching jobs. So getting, an increase that way, or at a time where expenses have been reduced. And that might be an option for some people, because if your employer is deciding to go hybrid or even not enforce a mandatory return to the office, all of that money that you've been able to save by not commuting and, fewer work-related expenses might be able to continue to help you boost up your savings a little bit. So, do whatever strategy works for you, but just identifying places where you can try to build up that money.
Okay.
Anything else?
Well, there were questions, but there are some questions about the I bonds. You said that one too quickly, but I just did put in the chat that you can investigate them at treasurydirect.gov.
Correct. Yeah, that's how you would buy them. They don't sell paper bonds anymore except through tax refunds. It's probably a little late to do that, unless you're filing an extension, and you might be able to put it on your extension tax return. But otherwise, you go through Treasury Direct, and there's a $10,000 per person limit per year.
Right.
Yeah.
Right.
Okay.
Okay.
Well, let's move on, and then we'll probably get some more questions as we go. We're going to stop through about the first half of the tips, and then we'll stop again at the end. And we should have plenty of time with an hour and a half program. We should have plenty of time at the end for questions as well. So let's get into just 25 financial planning tips. I don't have them in any particular order, so we're going to cover a wide variety of topics, investing topics, Social Security, health insurance, and many of the others that you mentioned in the chat. So let's start with number one. Is just because you've reached a certain age, it doesn't mean that all of the basics that you've been dealing with throughout your young and middle adulthood don't apply anymore. So you're still going to want to focus on these basics and prepare financial statements that help keep you in touch with your finances. So a cash flow statement periodically. So your income versus your expenses and seeing where your money is going. A net worth statement, which is your assets minus your debts. It's a good idea to at least once a year update your net worth statement so you can see how you're progressing with your finances, what the asset values are, how much debt you have, and then obviously subtracting the debt from the assets will give you your net worth. Also, you're still going to be setting goals, and we'll talk a little bit more about that. So making sure you have some specific goals that you're shooting for. And an emergency fund. you're going to need an emergency fund throughout your entire lifetime, because emergencies can happen in your 20s and 30s. They can happen in your 70s and 80s. And I encourage you to visit the website for Rutgers Cooperative Extension. I still have it online at Rutgers, and it just has dozens of downloadable worksheets that you can just download to your computer. They're not filled out online. You don't have to worry about privacy or anything like that. You just download them, put them on your computer. Some of them you can print out and do paper and pencil. There's some Excel spreadsheets as well. And this will give you the tools that you need to do these calculations that I just mentioned. The next thing you want to do is take a look at your insurance in later life. Do you need life insurance? It depends. Many people would say no, because hopefully your children have long been launched out of the nest and you're not protecting dependents anymore. You may have a need for your spouse, however, so that's something to consider, or there may be some other dependents depending on your family situation, like a special needs child, for example, something like that. Um, Life insurance can also provide for liquidity in an estate, and that's another use that sometimes people have for it. But just keep in mind that insurance, like term insurance, is going to get much more expensive as you get older. So it's something that you want to talk about with your insurance agent, and keep up with the pricing too, because policies can change over time, and the best price that you got on insurance on a policy, decades ago, you may be able to get something significantly different right now. And then there's your health insurance. So like I said before, you don't want to ever be without health insurance. And as you get older, you'll transition to Medicare, and you'll probably want to get a supplemental policy as well. Now, if you're very fortunate, you'll have a policy through your employer that will cover you as a retiree, but most people don't have that anymore. So you'll be looking for a supplemental policy. And I'll mention this later, but I'll also mention it now. There's an organization called SHIP, State Health Insurance Assistance Program, and they are very valuable resources for people who are looking into Medigap policies. They're usually associated with area agencies on aging, or divisions of senior services, or whatever they call it in government in your area. But they can help you identify the policies that are licensed for sale in the state of New York or wherever else you might be, and help you select a policy that might meet your needs. And then long-term care insurance. So again, do you need it? It depends. Some people suggest that if you have under about $250,000 of assets, it probably is not worth it, because you'll blow through those assets pretty quickly and be basically on Medicaid in a pretty short period of time. The sweet spot tends to be, and depending, different sources will count different numbers, but the sweet spot most often is somewhere between 250,000 to about 1.5 to 2.5 million of assets might be a good place to purchase long-term care insurance. And the reason there's a difference in a range on the upper end is it depends where you're going to be getting those services. If you're in a high-cost state like New York, you're going to be near the upper end of that range. If you're in a lower cost state like here in Florida, where I am, the costs will be lower. So you've got to kind of plan the insurance that you need based on the costs in the area where you expect to receive those services. And then above those amounts, you probably have sufficient resources to just self-insure, to earmark a portion of your assets as a set aside for potential long-term care expenses. And should you need that money, you have it. And if you fortunately pass away without never needing long-term care services, it becomes another asset for your heirs to pass on. And then other types of insurance that you want to make sure you're current on as well would be your property insurance, making sure that you have adequate coverage there. And of course, older adults have more wealth than people in their younger years. So if you have significant assets, and I'm talking in the millions of dollars, after you do your net worth statement and you calculate your net worth, if it's a million, two, three, four, five, or more million, by all means, talk with your property insurance agent and make sure you have an umbrella policy. So you have high liability limits in the event that um, somebody charges you, a liability kind of crime issue where you go to the courts and you have a judgment against you, you will have insurance to help pay for those damages. Because again, older adults tend to have more wealth. So all sorts of types of insurance that you want to look at: life, health, property, long-term care. Those would be the big ones. Possibly even disability. For those of you who are younger that are still in the workforce, you'll want to have disability insurance to ensure that you have money if you're unable to work. Okay, then let's get into investing. So the best thing I can tell you there is don't invest in anything you don't understand. So people are talking these days about Dogecoins and cryptocurrencies and all sorts of, non-fungible tokens and all sorts of things. And if you don't understand them, don't invest in them. And the best way to see if you understand something is try to explain it to another person. And if you can't explain it to another person in simple terms, you don't understand it yourself. So stay away. Learn about it if you want to, but don't invest in anything at the time that you don't understand it. Diversify your asset classes. By that, I mean stocks, bonds, cash equivalent assets like CDs, money market funds, real estate. Those would be major asset classes. And then even within those asset classes, different types of assets like long-term bonds, short-term bonds, large company stocks, small company stocks, international stocks. So you're getting good diversification. If you have goals that are 5 or more years away, that's where you choose investments like stocks, equities, growth mutual funds, things of that sort. If it's something that's very short term, like a goal that you have, a cruise, let's say you want to take in 2022, then you want to keep that money short term in a cash equivalent asset. So it's there when you need it. So investing is great for anything long term. But remember, too, that even if you're in your 60s, you can live till your 90s. So keep some money that is invested. It's the only way that you're going to outpace inflation. And many financial advisors talk about buckets where you've got your first bucket being like your short-term cash that you'd use for your short-term goals and your emergencies, and then maybe a medium-term bucket, and then your long-term goals you would be in your third bucket, and that money can keep growing through your 60s, 70s, possibly early 80s, and then maybe you'll need that money later on in your late 80s and 90s, and you will have gotten growth for several decades. So keep that in mind. Your investment time horizon is not the day you retire, it's the day you die. Basically, it's your entire lifetime. And then you want to have reasonable expectations. The average return on stocks since 1926 is about 10%. So you shouldn't be expecting anything, higher than that. I mean, if you get it, great, but it's not a normal expectation. And even 10%, most people aren't going to have all their money in stocks. So you're going to want to have an expectation of kind of the weighted average of the various places that you're putting your money and what their returns have been. You want to keep your investments low cost. So low expense ratios on mutual funds, low cost annuities if you choose to purchase them. Um, let's say index funds tend to be very low cost, so just really paying attention to reading a mutual fund prospectus, looking at the expense ratio, and trying to get as low cost as you possibly can. And then the other thing to keep in mind is that when you get older, you have more time, and you might be watching market news more often, whether it's CNBC or any other program that's talking about, real-time events in the stock market. And you just need to be careful not to get caught up in all that market hype and noise and everything. I mean, that's what those programs do. They hype up the market to get people to obviously view their programs. And you want to stay focused on the long term and your goals, and not be paying attention to the day-to-day noise that you're going to see. The Dow's up 500, the Dow's down 300. That's not something that you should be focused on. You want to be focused in on your goals, your asset allocation, and the reason why you bought investments in the first place. Okay, another issue, and this came out quite a bit on the questions that were submitted, is creating a retirement paycheck. So I have paycheck in air quotes, because if you've left the workforce, you don't have a paycheck. So you're saying, well, what kind of paycheck are you talking about? Well, you got to create your own paycheck. And there's a number of ways that people can do this. The first thing to think about is, okay, maybe you have an annual amount that you've decided to take out of your investments, and you may decide it, or the government may decide it, because if you're at 72 and over and you've got required minimum distributions, the uniform distribution table is going to tell you what your withdrawal amount, at least the minimum, has to be. You can withdraw more than that, but it will tell you a dollar amount. So for example, let's say your RMD was $5,000, and you decided that you wanted to take out that money on a regular basis. You could do about $416 a month if you did it monthly, or you might say, okay, $1,250 every quarter. So you can kind of, divvy up the money in a way that makes sense for you, taking it out on a regular basis. Some people will set up withdrawals with their mutual funds. When you're working, you tend to set up automatic deposits, that you put $50 every month into your mutual fund that kind of gets direct deposited out of your checking account. Well, you can do that in reverse when you're older, and you can authorize the mutual fund to put money into your checking account on a regular basis. And obviously that would last for as long as the funds in your mutual fund last. Some people set up what they call a ladder of bonds or CDs, where you buy them in a sequence, like maybe 6 months in a row, you buy a bond. And since bonds tend to throw off semi-annual interest, every month you'll have interest coming from that sequence of bonds. And people can do that with CDs as well. There are mutual funds out there now. They call them managed payout mutual funds, and they were set up to help people take money out of their mutual funds. And again, you set it up with them, and it's kind of based on market returns. You have to read the prospectus carefully to see exactly how they're managing that payout process. And again, that will last for as long as the money in your account lasts. Some people want to have a regular source of income that lasts their lifetime. So in that case, things that would fit that bill would be an annuity, which would be a contract with a life insurance company where you provide a sum of money, and in return, they pay you a stream of income for the remainder of either one person's life or two people's life if it's a couple. Or you could set it up that it will pay for a certain number of years. There's different payout options that you can get with annuities, but the thing that people like about them is that they provide that regular source of income for life. If you're fortunate enough to have a pension, that too will pay you income for the rest of your life. And then Social Security would be a third kind of annuity-like source of income, because it too will pay a regular benefit for the remainder of your life. And then another way to create a paycheck is to get a paycheck. So you might consider some type of continued employment, whether it's as an entrepreneur like I am, or contracting back with your former employer, or finding a new job, converting a hobby to a job. There's all sorts of different strategies that people can use for that. Okay, let's talk about RMDs, required minimum distributions. So some of you who are older on this webinar probably skipped that year last year, and because we had the suspension with the COVID, and RMDs are back, required minimum distributions. So what these are all about is taking withdrawals from your tax deferred accounts that some people have had in place for 2, 3, 4, even 5 decades. And now they've reached that magic age of 72 and they have to take money out. So this would be your traditional IRAs and any of the employer tax deferred plans like 401ks, 403bs, TSP if you're federal government, SEP IRAs, basically anything except a Roth IRA. And you have to take that first distribution no later than April 1st of the year after the year you turn 72. But just keep in mind, if you do that, if you postpone it to the following year, you're going to end up having to take 2 distributions for that following year, the one for 72 and the one for 73. So you need to do some tax forecasting before you decide to do that. Work with a CPA or even do the math yourself just to figure out, projecting out what your income will be at those different ages. And somebody asked a question, can you actually postpone things too long and have too much money saved? And I actually had a case like that. I counseled a fellow Rutgers professor some years ago who was 80 years old and was still working at Rutgers, but was planning to step away that year. And he had funded fully not only a 403b plan, but a 457 plan because he was eligible for both, and had $5 million in his accounts combined at 80 years old. And the RMD was going to be about $250,000. He was moving out of New Jersey, so he wasn't going to have state income tax, but he was going to have a really big federal income tax bill. So if any of you are in that situation, get some tax advice because you may want to start taking withdrawals before you take 72, because otherwise that money is just going to continue growing and it may catch up with you and bite you later. So get professional assistance if you are in a high net worth category. Your employer plans, like I said, you can delay until April 1st of the year after the year you retire. So if you work until 80, you can keep delaying, but it's gonna, you're gonna have a lot of money accumulated and then have to take out some really large RMDs. How you calculate it is your custodian on your account or your accounts, if you have more than one, they will send you a balance statement. You'll get it in the early part of each calendar year, and it'll show you the balance on December 31st of the previous calendar year. And then what you do is you take that balance and you look up in the uniform distribution table an age-based divisor, and you divide that a number into your account balance, and that tells you the minimum to take out. I should mention that there's going to be a new RMD table that takes effect next year. So for this year, you still use the old RMD table that's been in effect for many years. But next year, there'll be a new one that reflects a slightly higher life expectancy, which means that you will be able to withdraw slightly lower amounts than you could have previously. And get some assistance if you are taking your first RMD and you're confused. Your custodian should be able to help you, whoever's managing your plan. And just remember that if you don't do it correctly, it's one of the highest tax penalties in tax law. It's 50% of the amount that you should have taken out but didn't. So you want to definitely get the RMDs correct.
Excuse me, Barbara.
Yeah, sure.
I just did want to add to that you can generally call your bank or brokerage house or whatever, or they are mostly on your statements these days. They will tell you in the January statement what your RMD is going to be for the next year. So
Yeah, that's true. But again, always go back
you're,
to your custodian. Your custodian is your best source of information. Your former employer is probably not going to be able to help very much,
oh,
at
no,
this
no,
point.
no, no. Your
Yeah,
employer has nothing to do with it.
yeah,
Your
you
employer,
deal
they're
you
out of
deal with the
the,
custodian, whether
right,
it's, Vanguard, Fidelity, TIA, whoever your
right,
custodian is for your plan.
right, right.
Yeah,
It's never
they're
got the money.
more than happy to help you because, that's part of their business is to help people not only accumulate their assets, but also to distribute them properly and
Right.
comply with the tax law. Yeah. Okay, so many of you did have questions about minimizing taxes. So what you want to do, of course, is try to practice tax avoidance or minimization. Notice I'm not saying evasion. Evasion is illegal. That is not what we're talking about here. We're talking about doing everything that's legally possible under current tax law to reduce your taxes. Some of the best ways to do that, if you're still working, is to try to put as much money as you can into tax deferred investments, employer plans, traditional IRAs, if there's some tax benefit from doing that, Roth IRAs, trying to maximize as much as you can. And if you're age 50 and over, you can do the catch up. So you can put even more money in than if you were under age 50. Taking advantage of long-term capital gains. So you have to hold an asset for longer than a year, and then you pay a lower rate of tax. So all those people who were day trading last year with the GameStop and everything, they had all short-term gains, they taxed at ordinary income tax rates. But if you're holding the assets for, again, more than a year, you've got long-term capital gains. And then another way you can practice tax avoidance is if you have a particularly large income year. Like maybe it's the first year you're taking RMDs and you're kind of in uncharted waters there. You may want to consider doing some kind of bunching up of your itemized deductions if you can do that. Generally, the only way to do that these days is to donate a significant sum to charity, because there's really only a couple ways you can get good itemized deductions these days. The first is to have a presidential declared natural disaster. You certainly don't want that. And large medical expenses, you certainly don't want that either. And then, of course, the SALT cap limits your property and income taxes to $10,000. So that's not going to be enough to get over the standard deduction, which is $25,100 for a married couple this year. So the only way you're probably going to be able to bunch would be to make a significant charitable contribution to be able to get over the standard deduction amount so that you get some tax benefit from itemizing. Okay, another thing to consider is all your untitled personal property. So Cooperative Extension has a really good program that was developed in Minnesota called Who Gets Grandma's Yellow Pie Plate? And there's a YouTube video that you can watch that is kind of very instructive about that. And really what we're talking about is making plans for who gets your stuff. So thinking about the interests of family members, you have certain family members who have an interest in a collection that you might have, for example. Maybe you're going to make a written list of your property and heirs that you would maybe refer to in your will and make sure your executor is aware of so that it can be part of your property distribution plans. So you're going to share that list. And then you also might want to consider just lifetime gifting. Nobody says that all your gifts have to be made after you pass away. Some people get a lot of enjoyment just watching other family members enjoy their personal property as much as they did. Getting help when needed. So like I said before, older adulthood, there's a lot of decisions and challenges that we all face. So some of the places you might want to get help would be a certified public accountant, particularly if you have some kind of lump sum distribution that you want to manage and pay the least amount of taxes on. A certified financial planner, and again, you may hire a CFP one time only on a limited basis just to get all your questions answered, or you may want to have ongoing financial advice or even asset management assistance. And I put on the slide some places that you can go. There's letsmakeaplan.org is the Certified Financial Planner Board or CFP board. NAPFA is fee-only planners, and planner searches through the FPA or Financial Planning Association. Those websites will have a feature where you can put in your state or your county zip code and be able to find local advisors in your area. Obviously, an attorney if you're looking at estate planning assistance. And the one thing I would say with all these professionals is go prepared, because they're charging you by the hour and time is money. So if you can go prepared and you already have your cash flow statement, your net worth statement, your list of questions, and any germane documents, for the discussion, like if you want to talk about your 401k plan, have your statement with you, you can save a whole lot of time because they don't have to drag that information out of you. You've already prepared statements and made lists of questions, and you can get right down to business. And then other places to get help that wouldn't be in the financial services field, but also can be very valuable, would be SHIP. As I mentioned before, the State Health Insurance Assistance Program. They can help you find insurance policies that are approved by your state of residence, that they do Medigap, and they also do long-term care. So they won't tell you which policy to buy, but they will give you information about the characteristics, features, and availability of policies sold within your state. VITA is great for voluntary income tax assistance if you have a simple tax return. And then your area agency on aging can really be of assistance. Many of them have seminars, pro bono assistance programs, and of course the New York Public Library has many services where there are pro bono planners and others that are providing their time to help people with their finances.
And I believe someone's going to put the link to our financial counseling, our free financial counseling, in the chat box in the next moment or two.
Okay, wonderful. Yeah, like I said, the library has lots of great information and resources. Leaving a legacy. So people start to think about that in the last third of their financial life. And there's many different ways to leave a legacy and give back to others. Many older adults would say that their greatest legacy is their children and grandchildren, and maybe even great-grandchildren if you have them. People also can leave a legacy through their creative works, their art, their music. In my case, books. I've written 6 of them. People can volunteer, and also charitable gifting. And there's different ways that you can do charitable gifting, and these are all tax advantage strategies that you can use. Some people, I've talked about the bunching before, where you can give a large charitable gift in 1 year. Some people will do that in conjunction with setting up a donor advised fund, which is a charitable fund that you set up through a financial institution like a Fidelity, a Schwab, a TIA, some of those. People might, somebody was asking about taxes before. A QCD is another option where it's a qualified charitable distribution. If you have a traditional IRA and you're facing RMDs, you can direct the custodian of your traditional IRA to make a transfer of money from your traditional IRA to a qualified charity. The money goes directly to the charity. You never get it in your hot little hand. And that money satisfies, that donation satisfies the RMD that you would otherwise need to take, which increase your taxable income. So there's different strategies. Some people even will set up a charitable trust, like a charitable lead trust, a charitable remainder trust. You need to see an estate planning attorney to do that. But again, this is something that people often will think about more when they're older than they're younger, primarily because you have more wealth and less time. Communication is just so important. So just making sure that everybody that you name in documents, you've talked to them first. You know, don't do one of those raising Helen scenarios. If you remember that movie where she finds out in the will reading that, oh, by the way, you're the guardian of the children and you're the executor of the will. You want to talk to people ahead of time, make sure that they have agreed to serve as your executor and have a contingent executor lined up as well, a plan B. It's a great idea if you can share a financial notebook with the people that will be acting on your behalf. And it doesn't necessarily have to be a notebook or a binder. It can be a flash drive. It can be in the cloud with a link, but just a place where you've assembled all your financial information that will make it easy for people to carry on and to act on your behalf. A letter of last instructions can be very valuable. I prepared for my husband a what to do, who to contact list. So, you know, how to contact, things he has to do if I die first, you know, contact the pension plan to notify them of my death, contact Rutgers where I used to work, contact Social Security, you know, just all those things that somebody needs to do that are kind of a task list for them. Maybe in your discussions, you want to talk or write down what your burial and memorial wishes would be. I even wrote my obituary last year because I wrote about that in my book. And now, obviously, it's not complete. There's some fill in the blanks, but the gist of it, 95% of it is written. And then also make sure that you've discussed your health care preferences and personal property bequests with people who will be acting on your behalf. Keeping organized. This becomes really important as you get older. You want to have information simplified and organized. So on this slide, there are just some links for places that you can go, worksheets that you can download from the Rutgers website that can help you keep your documents organized. We talked about financial statements on the first tip, but there's also a digital assets inventory, a beneficiaries and personal representatives worksheet where you can list all of those people in one place, you know, your executor, your beneficiaries of your life insurance and your retirement accounts, and then also a list of individual personal finance data. So you can download these and use them to kind of start your financial notebook, if you will. And then learn the fine print about Medicare. So there's probably no better source of information about Medicare than Medicare.gov and the Medicare and You book that you will be sent every year once you are a Medicare enrollee. And they usually mail it out at the end of each calendar year to take effect with the information for the following year. They also have PDFs of that on their website. As I mentioned, you can contact SHIP, and in a few states like Florida, they call it SHINE, but it's basically the same group. It's trained volunteers who assist people with their decisions related to health insurance, Medigap policies. Stay abreast of changes in your retiree health plan coverage, because once you leave the workforce, you may not have as many ties to the HR emails and that sort of thing. So make sure if they send you information. For example, sometimes if you're in like a state or public employee plan, they can change providers. They might go from, I don't know, Blue Cross Blue Shield one year to Aetna the next year, and you just need to keep up to date with all the changes that are taking place. Budget for the healthcare costs in retirement. You know, one thing that you'll have to think about is, you know, the Plan B premiums. And some of you mentioned on your questions the IRMA supplement that you pay if your income is over certain limits. You're going to pay extra for your Part B and Part D premiums, and you'll just need to budget for that. And possibly, if you're on the cusp of paying IRMA, think about some ways that maybe you can shift income, maybe from a taxable account to a tax-free account that might get your income down below those limits so that those IRMA payments don't apply. And keep in mind too that healthier people spend more on their lifetime healthcare costs than unhealthy people. And you might say, well, how can that be? I'm healthy, I'm doing everything right, I'm walking 10,000 steps a day. Just keep in mind that because you are doing everything right and taking care of your health, you're probably going to live longer. And that means more years of out-of-pocket expenses, possibly a chronic disease later in life, and possibly the need for long-term care. So all those unhealthy people, they might die earlier in life than they would need to have all those things that will cost a lot more when somebody is kind of frail and maybe in their 90s. So just make sure that there's plenty of money set aside for healthcare expenses. The latest figure that I saw was a study that was done that said that a 65-year-old couple living to average life expectancy could expect to pay out of pocket about $295,000. And that would be over their remaining lifetime. And that would be all the out-of-pockets for co-pays, co-insurance, deductibles, and the like. So you do need to, I guess the way to put it is the price of having good health is the need for more wealth. And that's been borne out with research studies. Okay, so here's kind of a halfway stopping point. So Kathleen, I'll deflect to you to see if there are any questions that came in through the Q&A.
Okay. For all those who are concerned about links, you will receive a copy of the PowerPoint in the next 24 hours. So don't be concerned. You're going to have it in 24 hours one way or another. One question, Barbara, that I thought really needed to be addressed. I had somebody asked about a 401k plan, not understanding that they needed to take an RMD from the 401k. They seem to think they needed to move it into an IRA, and I know that you know better.
Well, I mean, there's always a possibility to roll over, from a 401k. You can certainly do that. But if you have a 401k and you're age 72 this year or past 72, you should be in communication with your custodian. And you can go online and Google the uniform distribution table, and maybe one of your staffers can do that right now and put a link. We have it up on the Rutgers website, but probably the best source would be the IRS. Find that on the IRS website. And yeah, you're going to need to know the balance that was on, December 31st of 2020. And then by the end of this year, you want to take that RMD. So be in touch with your custodian.
Yes.
And they should help you. And then maybe take advantage of some of the services that NYPL is offering for some pro bono advice as well.
Okay, and there's also a couple of questions on how do you determine how much money you're going to need? Now, you gave these people all the worksheets that they should put these numbers in, but people are concerned about how much money they will need, whether they should purchase long-term care insurance, which would be, again, based on income and wealth, whether they should buy an annuity, which, again, is based on income and wealth. Can you help them a little bit?
Sure. There's some good calculators out there. The one that I tend to recommend the most is the FINRA retirement planning calculator. So one of your people can probably Google that. Yeah. It's a really good calculator, and you'll put in numbers for your current age, the return you expect on your investments, the age that you'd like to retire at, your projection on your life expectancy, and you can keep changing the variables and do several different scenarios, but that'll give you some idea of how much you might need. The other way that you can attack it, particularly as you're getting close to retirement, is just do a cash flow statement, like I mentioned before, with your income and expenses, and then do a projected cash flow of what you think your income and expenses will be after you leave the labor force. And then you can kind of compare the numbers and see what gaps there might be as far as what you need and what you expect to have. So there's some good tools, and I certainly would recommend that you check out the FINRA calculator.
Right. And let me just ask, James, could you put the link to that FINRA calculator into the box? Into
Yeah,
the
and I'm
chat
seeing
box?
that somebody posted AARP, so they have one too. So yeah, there's a
There's a
number of
couple
them.
of them.
Yeah, and
Okay.
it's not a bad idea to use 2 or 3 because they may have certain slightly different assumptions, and then you kind of get a range of figures.
Okay. Fine. Thank you. And also, there's, I think several people don't really understand what a bond ladder is. And
Oh, okay.
let me complete that with, is it a better or worse idea than a bond mutual fund?
Huh, okay. Well, a bond ladder is where you would buy either bonds or CDs in a sequence. So bonds tend to throw off interest every 6 months. So you would buy, months 1, 2, 3, 4, 5, and 6, you would buy a bond. And then months 7, 8, 9, 10, 11, 12, you would have interest from each of that sequence of bonds. Each month each bond would throw off interest. So it's a way of kind of throwing off some regular income, and people would generally want to have that direct deposit into an account to make it simple for their finances. Now, the thing to keep in mind with bonds is there's something called interest rate risk. So when interest rates go up, as they have been, bond prices go down. And in reverse, when interest rates go down, bond prices go up. So with an individual bond, the only way you're subject to interest rate risk is if you sell that bond prior to maturity. In a bond fund, because it's a big portfolio of bonds that are contained within the fund, those bonds in the portfolio will be subject to interest rate risk. So, and you could do both. You could have a ladder of bonds, and then you could also have a bond fund. It's not an either or kind of thing. It's just a different way of investing in bonds.
There's a couple of questions on getting a power of attorney, on how to utilize it when the person whose power of attorney you have doesn't wish to communicate with you, and also if there's nobody you trust, who do you choose for power of attorney?
Well, that's something that's a conversation you would want to have with your attorney as to suitable alternatives. In some cases, you may choose a professional. Although I have read articles where some professionals, whether it's financial planners or attorneys, are hesitant to take on roles that typically a child would take on if there was a child in the picture that you trusted. So have the conversation with your attorney as far as suitable alternatives, because they probably could give you some ideas what to do. I think I'll do, Kathleen, is let's keep on going, and then we should have some time at the end, so we don't want to miss out on the other remaining 13 strategies here.
Right.
So one thing that is concerning to a lot of people, and you mentioned it in the chat, several of you, was having your money last as long as you do. So this is the whole issue of prudent asset withdrawals. You may have heard about a classic study that was done that talked about the 4% rule, where you withdraw 4% of your accumulated assets, whatever the amount happens to be, and you take out 4%, and then you inflation adjust it, maybe 3% of that 4% figure every year for inflation. That was a study that was done in the 1990s, early 1990s, and a lot has changed. So some of the more recent research is suggesting that we've had such low rates of return on fixed income securities for decades now that maybe the better percentage of your assets to take out to assure that you don't outlive your money. And they typically did that research assuming that it's a 30-year distribution period. Maybe it's only 2.5 or 3%. So what I talk about in my book is tweaking the 4% rule, because it's not set in stone. And also keep in mind that the 4% rule was made with the assumption that people had half of their assets in the stock market. So if you're a very conservative person and you don't have anywhere near that percentage of your assets in stock, that rule wouldn't apply to you anyway. So you'd have to be less than 4% because you're a very conservative investor. And likewise, if you're a person that's in your late 70s or 80s and you're still working and you haven't withdrawn anything, other than maybe RMDs, you would have had to, then maybe you take out more because you probably don't have a 30-year life expectancy at age 78, for example. So what I'm saying is that the rule has to be tweaked for your individual circumstances. Don't just take a guideline and say that it works for everyone. There are some calculators you might want to try called Monte Carlo calculators. If you just Google that, you'll find a number of them. And they're kind of another type of retirement planning calculator, but instead of giving you a number that you have to save, like the other calculators I mentioned, they give you a probability of having your money last for 30 years. And you have like different data entry things that you'll put in, some of the same data that I mentioned before, like your age and your investment return. And they can be very instructive too, because if you're running a Monte Carlo calculation and have a low percentage of having your money last as long as your expected lifetime, then that's kind of a red flag that you'll have to take some action, whether it's a catch-up strategy like working longer or investing differently or downsizing your housing expenses, some kind of workaround to make the numbers work. And you might consider hiring a financial professional. They have very sophisticated calculators too that they can use to make projections about how long a sum of money will last. You want to have your taxes withheld correctly, because as I mentioned before, in later life, you may have many taxable income sources. You may have a pension if you're lucky, Social Security, RMDs, a job or self-employment, capital gains, all sorts of income coming together that all is feeding into your taxable income for the year. So you want to make sure that your tax withholding is accurate. The IRS has a good withholding estimator tool that you can use that will help you with that. And also another thing that can keep you on the straight and narrow is there's something called a safe harbor. And a safe harbor you can kind of think of as a get out of jail free card, that if you do certain things, you are off the hook for paying certain penalties. So the safe harbor for under withholding is if you can make sure that you either have withheld and or estimated payments sent in 100% of your previous year's tax. And if you have an AGI, adjusted gross income, of $150,000 or more, it has to be 110% of your previous year's taxes. So just make sure you're using your last year's taxes to inform the amount that you have taken out or estimated for the current year's taxes. And, July is a really good time to do a mid-year tax mock-up too, because we're halfway through the year and you already know what you earned for the first half of the year. You should have a pretty good idea of what you're going to be earning for the second half. And particularly for people who are freelancers, when there's not a steady income, you can do a projection to make sure that your withholding is accurate. Here's another tip. Just increase your personal finance knowledge. So learn one new thing every day about personal finance. So taking this webinar, you've got it covered for today. But other things that you can do, blogs, social media, Wall Street Journal or other newspapers that have financial sections, classes, webinars, podcasts. You pick a method that works for you and try to learn one new thing. And then what I do is when I learn new things, because I attend a lot of webinars and presentations, I have a personal learning journal. So I take notes from all of those things that I'm learning, and then I have them written down if I want to refer to them. Laddering, we've already talked about, so I'll just reiterate this again. This is with your fixed income and your cash equivalent assets. So you're staggering the maturity dates of when you purchase different things. And what you're doing with laddering is you're hedging your bets, because if interest rates go up, you have some of your money that is coming due, that like a CD that's about to roll over, that you can invest at a higher interest rate. And yet if interest rates go down, then you have the assurance, well, at least I have some money invested at that rate that I, was higher before. So it kind of hedges your bets. It also gives you liquidity if you do have to pull money out. You have several different CDs or bonds instead of having all your money in one CD or bond. So it can help with that paycheck that I mentioned before. Okay, you're an older adult, play the age card. So take advantage of all the senior discounts that are out there. And senior can begin as early as 50, 60, 62, 65, depending on who's given the discount. They all have their fine print, but take advantage of all the discounts, national parks, movies, theme parks, restaurants, you name it. You also get an extra amount of standard deduction if you're age 65 plus. So make sure that you're taking that on your income tax return. In some locations, people who are older adults will get discounts on their property taxes. So that's another discount. And then just anything that has discounts, just, look for them or even ask about them. Some clubs or associations have, lifetime member or, emeritus member, any way that you can play the age card that can save you money is a good thing. Okay, scams. We got to talk about scams. Older adults are a prime target for scams. And so several reasons for this. Obviously, it's where the wealth is. Remember that old Willie Sutton phrase, he robbed banks because that's where the money is. Well, that's true of older adults. They have more wealth. They're more easily reached if you're not at a job all day. They catch you at home, less technologically savvy, and then unfortunately for some people, diminished capacity steps in, and that can put you at risk for fraud as well. According to the FTC, the 4 most common scams that affect older adults are tech support scams, imposter scams, where somebody pretends to be from a bank or some store or somewhere, lottery scams, and romance scams. Those are 4 very common scams for older adults. Some of the red flags that should immediately alert you to fraud would be any kind of request to wire money, to do anything immediately, to pay with prepaid gift cards, to give codes from gift cards, paying in advance for any kind of service or product, and anybody who encourages secrecy, like, oh, don't tell anyone, this is just between us kind of thing. These are all risk factors. Another one is going to the free lunch or free dinner seminars. If you do decide to go to them, just be careful out there. I went to several of them undercover right before COVID started, and I'm actually going to another one undercover tomorrow because nobody knows me in Florida. Too many people knew me up in Jersey. And there's just a whole lot of red flags there, people that are just, wanting your contact information, and, if not outright wrong information, just inappropriate information. So just be very careful. You want to build your resiliency resources. This is important at all stages of life, but particularly in later life, when people sometimes have friends and family members that pass away. So there is a resiliency resources quiz you can take online at Rutgers that will give you some indication of the resources that you have that can build your resilience. Not all of them are financial too, because social capital can be a big resiliency factor. And in fact, research has shown that relationships are really important in later life. Okay, another thing to think about is spending down. and getting comfortable with that, and realizing how difficult it is to switch from being a long-time saver to a spender. And that's really what the genesis of my book, Flipping a Switch, is all about. So if you have the resources to do so, stepping outside your spending comfort zone, and that might be going to a play and sitting in orchestra seats instead of mezzanine, or just ordering a higher course meal that you might at a restaurant, just getting comfortable with that. And again, seeing a financial advisor and seeing them run the numbers for you to show how prepared you are for retirement. If they're showing that you have adequate resources, consider some ways to spend down. Automating your savings withdrawals, because psychologically it can feel like a loss when you take money out of any kind of account. So if it's done automatically, it feels less of a loss. And the first chapter of my book is this question. Think about, if you don't spend your money, who will? And sometimes that is an incentive to want to spend some money too. Okay, decide when to collect Social Security. So sometime in your 60s, you're going to become a Social Security beneficiary. The earliest you can claim is 62. The latest that it makes sense to claim is before age 70, because then the delayed retirement credits end and there's no economic benefit to going beyond there. So you pick an age. I can tell you from research that only 3.7% of beneficiaries claim at age 70. So most people are claiming either at 62. I think more than a third claim at 62, and the great bulk of people, the rest of them claim at their full retirement age, which can be anywhere between 66 and 67 now. Anybody born after 1960, it's age 67. And baby boomers, it's somewhere between either 66 or between 66 and 67. So just understand that if you claim early, there's going to be a permanent benefit reduction. And, don't make that decision lightly, because it will affect the income stream that you have for the remainder of your life. Be aware of the Social Security earnings limit. So this year it's $18,960. So if you claim early before your full retirement age and you earn higher than that amount, you will be paying back $1 for every $2 over that amount. And then for many people, your Social Security is going to be taxable. So either make arrangements with Social Security or make estimated payments to the IRS for the tax liability on your Social Security benefits. And then also consider your spouse when you're making your decisions about what age to claim. The traditional advice is for the higher earning spouse, if there's a great discrepancy in the earnings between two spouses, to have the higher earning spouse work as long as possible to, particularly if that spouse is also older. And then that way, not only will they get a higher benefit when they claim, but also it will result in a higher benefit if they pass away first. Set through retirement goals. So when you're younger and you're in your early and middle adulthood years, retirement is probably a goal and you're trying to get to retirement. But when you're leaving the workforce, then you're going to get through retirement. So you're still going to do whatever you did when you were younger. You want to set a goal that is what we call a SMART goal, that has a deadline and a time frame and a dollar amount, so you can make it very specific. SMART is an acronym for specific, measurable, achievable, realistic, and time related. And then also make some plans for spending down your accumulated savings, particularly with your RMDs, because when you start taking RMDs, you're going to have three choices of what to do with that money. You can either spend it, you can gift it, or you can resave it somewhere. So you should have an RMD spending plan when you get to age 72. And then, like I said before, if you have the ability financially to do so, you may want to think about upgrading your goals if the numbers show that you can afford it, and spending a little bit more than maybe you had thought you would do previously.
Uh,
Simplification is key. So consolidating like assets. So if you have multiple IRAs, you may want to consolidate them, or mutual funds. Again, just to have fewer statements and to make it easier when you start taking out the RMDs. Accounts that aren't doing very well, you may want to close them. You may want to take a look at your automated payments. Some people have payments going to gyms and they haven't been into a gym since COVID. So you may want to make sure that all the automated payments that are coming off your bank account or credit card are things you're still using. And then purging and shredding, very old documents that you don't need to save anymore, or scanning them and then not having to have all the paper around. Those are ways to simplify. Okay, achieving peace of mind. So some things to think about here. This is another chapter in my book where I just talked about, okay, what is peace of mind? Peace of mind is knowing that you'll be okay. So some ways to do that would be just periodically checking your financial status, your net worth, or a Monte Carlo calculation, any of the things I mentioned previously. Regularly reviewing your income and expenses, maybe checking in with a certified financial planner, maybe not on a regular basis, but occasionally. Or if you have a regular relationship, obviously you would maintain that. And then make sure, for a lot of people, the big thing that they're afraid of is long-term care. So just address the elephant in the room with some kind of plan, whether it's self-insurance or long-term care insurance or something of that sort. So in some cases, people even have their children help pay the premiums for their insurance policy. Okay, I just want to close with a few more slides, and then we should have a few more minutes for questions. So my last tip is just to flip all the switches in your life purposefully. And again, this is the title of my book, and flipping switches is a metaphor for transitions that you're making in later life, not just financial transitions, but many others, as you'll see on the next slide. And in all of these cases, you need information and you need some preparation. So my book is organized according to 3 sections. We've got financial transitions, social transitions, and lifestyle. And I just want to highlight 3 transitions that affect your finances. But first, I want to just mention that some transitions that you'll make will be like a light switch. You'll just kind of go on and off. And others will be like a dimmer switch that you'll turn and gradually change over time. So some of the things that people tend to do gradually would be maybe a change in their work hours, maybe like a phased retirement type of thing. Their spending can change gradually, their investment asset allocation. Downsizing is going to take some time for sure. Simplification, all of these things you can do gradually. On my website, I've got a number of podcasts and webinars. So if you want to learn more about some of these changes that people make in later life, you can connect to those directly. And I just want to end with 3 non-financial switches that have financial implications. So the first one is finding fulfillment after full-time work. And FIND is an acronym: Financial Independence, New Directions. So you'll need to leave work with a plan. Know what you want to do when you leave the labor force. And have some plan for how you're going to spend your days. This will make you happier than if you just leave and have no plans about what to do. If you think you're going to get back into the labor force, don't disappear for too long. Most career experts say don't leave any more than 2 years, because you'll just be considered rusty and irrelevant because you've just been away too long. Cherry pick things that you like to do. And as many of you mentioned in the chat before, you'll have to expect some ageism. And one of the best ways to combat ageism is to work for yourself, because you hire yourself, but also things that can be subtle, whether it's hair dye or the way you dress. And, those things can affect ageism too. And also make sure that your skill set is current. Keep up to date with technology, very important. So schedule your day around big rocks. If you remember Stephen Covey, he talked about big rocks. You put the big rocks in the jar first. Those are your high priority things. And then you kind of sprinkle in the small rocks and the sand around it. Well, same thing with your time in retirement. Figure out what your big rocks will be, whether they're work, volunteerism, caregiving, whatever you're going to do that will take the bulk of your day. That's your big rock. And then schedule around that. Identity bridging. Research has found that if you carry into retirement some of the things you did before retirement, that can make you happier. So whether it's the type of work that you did or the type of volunteerism that you did or some habits or hobbies makes people happier. You'll have to redefine your own productivity metrics. When you were working, your boss defined how productive you are. But when you're retired, you get to decide. So whether it's walking 10,000 steps a day or talking to 20 people, you have your own metrics. Set your own goals and stay connected with other people. And then the last chapter that I just want to touch on is Invincible to Vulnerable, which I wrote just as COVID was taking hold last year. And as older adults, we do need to consider the fact that we are vulnerable. And I remember when the CDC first came out with calling anybody over 60 the elderly and saying we were at high risk for COVID. And I said, I'm not elderly, and then, when you saw the research about immune systems, we realized that, yeah, I guess we are vulnerable. So just accept it. Try to do everything you possibly can to stave off disease and delay any kind of chronic diseases like diabetes, because obviously that's going to save a whole lot of money. Following healthy lifestyle recommendations and getting recommended vaccines and screening. So I want to close by just wishing you best of luck for all the flip switches in your life. And we'll take some time if there's any final comments or questions. And I also want to, before we do that, I just want to thank you all too for the gift of your time. You spent 90 minutes with me today. You could have been doing something else. So I thank you for spending this time with me. And I hope that you found the presentation helpful. And I think I'll stop the screen share now and just defer to Kathleen for any final questions or comments.
I do have a couple of questions, and we don't have too much time, but someone is asking is whether setting up a trust is appropriate, assuming you have beneficiary designations in all your financial accounts and a will.
Well, I mean, your beneficiary designations will transfer property as per those designations. So a trust would be any other property that you have that's not, there are other ways to, besides beneficiary designations, there's also joint ownership of property. Those things will always take precedence. If you own property with another person, and it's a joint ownership scenario, it's going to go to that other person. If you've named somebody as a beneficiary, it's going to go to that named beneficiary. So if you have other things, other assets, and they're significant enough that you may want to have the management of a trustee, you can look into it. Obviously there's some legal expenses involved. You'll also have to retitle all those assets that you put into the trust from your own individual name to the trust name. So there's, a paperwork process involved with that as well. I would start out by making an appointment with an estate planning attorney, and maybe you have some pro bono services at the library as well, and getting kind of the pros and cons of it, and then moving forward if it makes sense for you.
There is also, Barbara, in general, a confusion about different kinds of IRAs. So the particular question is, should I move an inherited IRA into my regular IRA? But there's also the 401ks being rolled over. And I guess I guess I guess people just do not understand how these things can be linked or whether they need to be linked.
Mhm. Well, I mean, again, I would talk with the custodians on both ends on how to
Probably
do that.
multiple custodians.
Yeah,
Excuse me.
exactly. Both ends. Because if you're going to do a rollover, you have to have it set up on the receiving end and you have to direct the person on the sending end. So I would talk to people on both ends of the process to review the pros and cons and also to review the process. For example, I was talking to somebody recently about that because I have a traditional IRA that I want to move to another custodian and convert it to a Roth IRA. It's not as simple as it seems because you have to set up the Roth IRA. You have to set up a traditional IRA with the second custodian and then roll it over to a Roth IRA. So instead of having 2 accounts involved in the process, it's actually going to be 3 accounts. So there's some paperwork process. So I would start out by just talking to the custodians on both ends and allow yourself enough time. So this is not something you want to be doing in the middle of December either, because there's paperwork processes involved.
Yes, and the other one thing I would remind everybody is you don't want to take any payment in cash unless it's your RMD. You want to do the transfer process that Barbara's talking about, where you talk to one custodian, then you talk to the other custodian. You don't want the cash in your hands because you only have a few days, 60 days to get it back into another account. Barbara, you froze.
I did. You froze too, but I can still hear you. So I think that's good. We're getting thunderstorms, so I don't know if that's the reason.
That probably is, but I'm glad it waited till 1:30 to happen. That really is the question: can you contribute to an IRA if you have no earned income? And the answer to that is no.
No, you have to have earned income.
Okay.
Which can be from a job or self-employment or both.
Right. To avoid the Irma cliff, the person is now 63. Is there any way to predict what the cutoff will be in the next 2 years?
Well, I mean, you can take the current amounts and probably add the inflation factor to it. Now, interesting enough, inflation, the CPI can help you or hurt you. So if you're getting Social Security or a federal pension or something like that, the inflation rate is higher this year than it was last year for sure. We've seen that with our gas and our food and everything else. So, you can, kind of, add 3% to what it is now and do that maybe for this year and, next year and the year after. It'll give you a rough ballpark because they're using this consumer price index to do this indexing for things. And that'll give you a rough idea of what the IRMA amounts will be. And then, like I said, if you're right on the cusp of having to pay, IRMA, which again is the surcharge for higher income taxpayers who have Medicare Part B and Part D, if you're right on the cusp, you might be able to proactively take steps to lower your income to get below. But I mean, for some people, you're just so far over the IRMA limits that, you just basically have to suck it up and pay it. There's not going to be many other strategies. But people that are close can be proactive about it for sure.
Okay, and with that, I think we're going to have to end this webinar.
Okay.
Thank you very much, Barbara. I think it was quite informative. There's a lot of information in there, and I know that many people are looking forward to receiving your PowerPoint with all those wonderful links.
Yeah, that's great. And I also have it on my SlideShare account too, that I had that link in the chat as well. So if you can't wait for the library, you can go to slideshare.net and get it right there on my account.
Right. We'll generally get it to them within 24 hours, but it does take us a little while to get everything together. But again, thank you very much, Barbara. And with that, we're going to end the recording and